Welcome to our class once again. This is Taxation 231, and we are on Chapter 8, which is Allowable Deductions from the Gross Income. This is your host, moderator, instructor, attorney Lyndon Maceren, CPA lawyer. And we'll start with the question: what are allowable deductions from gross income? So this is found in Section 34 of the National Internal Revenue Code, and the trade law, no? Except for taxpayers earning compensation income. So accordingly, except for taxpayers earning compensation income arising from personal service rendered under an employer-employee relationships, where the deductions allowed are the maximum limit of 90,000 as 13th month pay and other bonuses, and SSS, JSIS, PhilHealth, Home Mutual Development Fund, and employees compensation coverage contributions. So these are the deductions of pure compensation earners. No? There are only two, of course, including de minimis benefits, but they are not they're not included as part of the compensation income. These ones are included first, then deducted. If you would get a form of the 1700, the 13th month pay and other bonuses are added first, as well as the contributions, but then later they are deducted as allowable deductions. Okay, so a taxpayer, individual taxpayers engaged in trade or business or practice of profession, or TBP, of course except non-resident aliens, they may opt to avail any of the following allowable deductions from the gross income. So first, there is a standard deduction, and the amount is not exceeding 40% of the gross sales or gross receipts. Now, in case of corporation subject to tax, it may elect a standard deduction in an amount not exceeding 40% of its gross income. So if there's a gross sales or gross receipts, then times 40%, that is the allowable deduction or standard deduction. For corporations, it's still the same, 40% of the gross income in order to get the net income. So to avail of the standard deduction, the taxpayer must signify in his return his intention to elect the optional standard deduction. So this is also known as standard deduction, or OSD, optional standard deduction. In return, the taxpayer shall not be required to submit with his tax return such financial statements like the balance sheet or the income statement or the comprehensive statement of income or the comprehensive changes in financial position and cash flow. So in return, further, if there is a GPP or general professional partnership, and the partners comprising such partnership may avail of the OSD only once. So either by the GPP or by the partners comprising the partnership. So they cannot avail both. The GPP, if once it is taken by the GPP, then the partners cannot avail of OSD, and vice versa. So provided that the taxpayer shall keep such records pertaining to his gross sales or receipts, or in case of corporation, its gross income records during the taxable year. Now for taxpayers opting as it itemized deductions, so okay, so that's standard deduction. Okay, another kind of deductions are those opting itemized deductions. So the itemized deductions are uh, they are deducted from gross sales or receipts, or in case of corporation, from gross income. So these are the following itemized deductions: expenses, interest, taxes, losses, bad debts, depreciation, depletion of oil and gas wells and mines, charitable contributions and other contributions, research and development, pension trusts. So I made a acronym which is Exentaloba Dip Chap8, no? Chari8. Oh, lacking research and development. So Chari8. This is Chari8. So first, expenses. No? Expenses can be classified into two, either revenue expenditures or capital expenditures. So revenue expenditures are ordinary recurring expenses that provide benefits to current accounting period. So only for the taxable year. It does not surpasses the taxable year, or meaning it is good only for the year, and it does not surpasses to another year. So these are the different kinds of revenue expenditures: operating expenses, salaries and wages, supplies expense, repairs and maintenance, such as painting, lubricating, cleaning, utilities, gas, heat, power, water, and communications, advertising and other selling expenses, traveling expenses while away from home, solely in pursuit of trade, profession, or business, insurance premiums against fire, storm, theft, accident, or other similar losses in trade or business, and other recurring expenses that benefit only the current operation and do not improve or extend the life of an asset used in business. On the other hand, capital expenditures are non-recurring expenses related to acquisition of depreciable assets used in business but not for sale, and they have a useful life of several years. So capital assets, they are capital expenditures. So they provide current and future benefits. So the cost incurred or paid is capitalized and not immediately expensed. They are gradually expended from period to period in the form of depreciation or amortization within the within its useful life. Capital expenses are those which increase an asset's useful life or increase it in capacity or increase in efficiency. If these qualifications are not met, then the expense should be classified as a revenue expenditure. Now, requisites for deductibility: it must be ordinary and necessary for the conduct of business or exercise of profession, so meaning it's not a capital expense. Then it should be substantiated with official receipts or other adequate records. So the requisites for deductibility, so this all must be present, no? In order that the expenses can be deducted as allowable deductions. Then more of the requisites. Third, it must be reasonable in amount. Fourth, withheld with tax and paid to the BIR. So if required, such as salary, rent, etc. Commissions, no? So if, like for example, salary and wages of employees, it is there are taxes withheld, and it should be remitted. Otherwise, if there are no taxes withheld, then it cannot be allowed as a deduction. Rent also, the lessee must withhold the tax which should be remitted to the BIR. Otherwise, it cannot be allowed as a deduction. So fifth requisite, it is not contrary to law, morals, public policy, or public order, and incurred or paid and deducted within the taxable year. Then there are sometimes compensation to employees for injuries and pensions of employees made by an employer. They are allowed as deductible expenses because these are compensation paid for a limited time to the widow or the heirs of the employee in recognition for the services rendered or as salary paid to an employee during a period of incapacity. Now, materials and supplies, they can be either direct or indirectly used to produce products for sale. On one hand, only used or consumed supplies are deductible from ordinary income. So, if there are unused supplies, it can be treated as unused. No? It can be treated as an asset, not as an expense. Also, traveling expenses, they can be deductible from the gross income. It includes meals, lodging, transportation, fare incurred within or outside the country while away from home in pursuit of trade, business, or profession. And rent expense are costs of using or possessing a property owned by another in pursuit of trade, business, or profession. It can either be real or personal. It is deductible when paid or incurred and provided the corresponding tax is withheld and remitted to the BIR. However, an advance rent or deposit is not considered as an expense to the lessee. It can only be considered as expense once it is incurred. Representation expense are entertainment, amusement, and recreation expenses incurred or paid during the year that are directly connected to the development, management, and operation of the trade, business, or profession. So this trade, business, or profession will now make an acronym as TBP because they are constantly repeated. So it is subject to the following ceilings. Number one, it should not exceed 1/2 of net sales for taxpayers engaged in sale of goods or properties. So there's a ceiling. No? If it exceeds 1/2, then it is disallowed by the BIR. Secondly, it is limited to 1% of the net revenue for taxpayers engaged in sale of services, including exercise of profession and use or lease of properties. So the first ceiling is for traders or merchandisers. The second ceiling is for services or profession or leasing of properties. So requisites for deductibility of representations expense. It must not be contrary to law, morals, public policy, or public order. It must be substantiated with evidence such as receipts or adequate records. It must comply to the above ceilings. And fourth, there must be some definite reasonable purpose connected with one's TBP, trade, business, or profession. So there's a note here, the giving of parties to entertain one's employees and personnel does not indicate a definite business purpose because it is only for employees. So business purpose should be related to the clients or customers. So second deductible item is interest. So these are the requisites for deductibility for interest. There must be an indebtedness stipulated in writing. So meaning there's a contract. And the indebtedness must be that of the taxpayer in connection with the trade, business, or profession. It must be paid or accrued during the taxable year, and the interest payment must not be in favor of a relative. An interest expense deductible is subject to some limitations. Now, if the taxpayer has interest income, which is subjected to a 20% final tax, and at the same time incurred an interest expense during the taxable year, so the interest expense shall be reduced by 33% of its interest income. So example, Mr. T is engaged in business, incurred an interest expense of 400,000 pesos, and in the same year also earned 300,000 from time deposit in the bank. So daghan siya kwarta. And which is subjected to 20% final tax. So how much can Mr. T deduct as interest expense? So the actual interest expense is 400,000. So according to the limit, this should be reduced by 33% of his interest income. So his interest income is, where's that? 300,000 pesos here. So 300,000 pesos times 33% gives you 99,000 pesos. So you deduct 99,000 from 400,000. So the deductible interest expense of Mr. T is 301,000. So interest to finance petroleum exploration is non-deductible because this is exempt from income tax. The petroleum exploration is exempt. No? This is appropriately capitalized as deferred exploration cost. At the option of the taxpayer, interest incurred to acquire property used in TVV or trade, business, or profession may be allowed as either an outright deduction from gross income or treated as capital expense and amortized through the asset's useful life. So if the taxpayer incurred interest in acquiring a property, so that interest expense can either be as an itemized deduction, meaning it can be deducted outright, or treated as a capital expense and part of the acquisition cost of the property. Okay, third item, which is deductible from gross income, if the taxpayer opted the itemized deduction or taxes. No? So the requisites for deductibility of taxes that must be paid or incurred within the taxable year. It must be paid or incurred in connection with the taxpayer's trade, business, or profession, and it must be imposed directly upon the taxpayer. So these are the following deductible taxes if incurred in relation to trade, business, or profession. Occupational taxes, privilege and licenses taxes, excise taxes, import duties, documentary stamp taxes, local business taxes, automobile registration fees, community tax, municipal tax, income tax paid to foreign country if it is not claimed as a tax credit. So taxes which are non-deductible from gross income are income tax, and other income taxes imposed by authority of any foreign country, except in the case of the taxpayer who does not signify in his return his desire to have it to any extent the benefits of tax credits for taxes of foreign countries. Now, if the taxpayer signifies in his return he desired to avail of tax credits, then the tax under the NIRC or the code shall be credited with the amount of taxes paid or incurred during the taxable year, or in case of partnership and estates, the individual who is member of the GBP or beneficiary of an estate or trust, his proportionate share of such taxes of the GBP or the estate or trust paid or incurred during the taxable year to a foreign country, if his distributed share of the income of such partnership or trust is reported for taxation under the code. So an alien and a foreign corporation are not allowed the credits against the tax for the taxes of foreign countries. So there is okay. To continue, taxes which are not deductible from gross income includes estate taxes and donor taxes. Taxes assessed against local benefits of a kind tending to increase the value of property assessed. So these are called special assessment tax. Then value added tax. So there are also limitations for taxes. No? The amount of credit shall not exceed the same proportion of tax against which such credit is taken, with the taxpayer's taxable income from sources within such country and under the tax code bears to his entire taxable income for the same taxable year. So the total amount of the credit shall not exceed the same proportion of the tax against which such credit is taken. So the tax credit, it cannot be, the taxes which are paid outside foreign country is, there's a limitation. So we'll discuss the formula instead to make it easier. So number one, if per country limitation for taxes paid to one foreign country, the formula is the taxable income from foreign country divided by the taxable income from all sources, then times the Philippine income tax equals your tax credit limit. So this pertains to resident citizens who have taxable income from foreign country. Then overall limitation, if there is, this is for one country only. Now for the overall limitation, let's say the taxpayer has several income tax paid from different countries. So the taxable income from outside sources divided by the taxable income from all sources. So times the Philippine income tax equals the tax credit. So just remember this formula. So the allowable tax credit is the lower amount between the tax credit computed in 1 and 2. So you have to compute both. Whichever is the lower is the tax credit. So for senior citizens, they are allowed 20% discount and it's treated as tax credit, not as deductible cost. These are for taxpayers who are giving 20% discount to senior citizens. So the discount afforded to senior citizens is treated as a tax credit, and it is not deducted as a deductible expense. No? Okay, fourth itemized deduction is the losses. So what are the requisites for deductibility of losses? First, it was actually sustained during the taxable year, and it's not compensated by insurance or other forms of indemnity. Third, if incurred in trade, professional business. And fourth, property connected with trade, business, or profession if the loss arises from fires, storms, shipwreck, or other casualties, or from robbery, theft, or embezzlement. So the losses is of the property. So exception, if claimed as a deduction for estate tax purposes, then there is need for proof of loss. Okay. Sometimes when a company or when a taxpayer experiences loss or operating loss, it can be carried over. So for any taxable year, this is operating loss, no? The gross income minus deductions equals net loss. So we're talking about net loss, not as loss of fire, not operating loss. It can be carried over, and for 3 consecutive taxable years. So for any taxable year immediately preceding the current taxable year, which has not been previously offset as a deduction from gross income. So let's say the taxpayer has a net operating loss for this year. So, and then for next year, there is net income. No? So his net income can be reduced by the net operating loss incurred last year. So it can be carried over up to 3 consecutive taxable years. So immediately following the year of such loss. Let's say the loss is 1 million, and for the next year there's a net income of 500,000, so it can be carried over. So there is no tax payment for the following year because it's deductible. No? Then in the third year, the net income is only 100,000, so it can still be carried over. Then on the third year, another 100,000 income, so it still can be carried over. So total deductions made from the operating loss is only 700,000 pesos. So I've said the net loss was 1 million. So what will happen now to the excess of 300,000 pesos? It will be considered as loss. No? It cannot be deducted on the fourth year when after the loss was incurred. So it's only up to 3 consecutive taxable years, the carryover of the loss. Okay. So any net loss incurred in a taxable year during which the taxpayer was exempt from income tax shall not be allowed as a deduction. So allowed only if there has been no substantial change in the ownership of the business. So meaning the ownership is still the same. Not less than 75% in nominal value of outstanding issued shares if the business is in the name of the corporation and is held by or in behalf of the same persons. So if there's substantial sale, then the net loss can no longer be carried over. If more than 75%. If not less than 75% of paid up capital of corporation, then if the business name is in the business name corporation is held by or in behalf of the same persons. Alright, let's go to bad debts. Bad debts can be deducted from the gross income. These are debts due to the taxpayer and actually ascertained to be worthless and charged off within the taxable year. So except those not connected with profession, trade, or business, and those sustained in transaction entered into between parties. So it must be connected with the trade, business, or profession, TBP. So what are the requisites for deductibility? Number one, there must be a valid and subsisting claim. Number two, the claim must be connected with trade, business, or profession. Third, the claim must not be between related parties, meaning not your father, not your mother, no, or not your stepbrother. Fourth, the claim must actually be ascertained to be worthless and uncollectible as of the end of the taxable year, and the claim must be written off within the taxable year. Okay, the sixth itemized deduction is called dispersation. Dispersation is the reasonable allowance for the exhaustion, wear and tear, including reasonable allowance for obsolescence of a capital property or real property or a capital asset used in the trade, business, profession located within the Philippines and charged off during the year. So there are four methods, no? Or there are several methods actually. So the first allowable method is the straight line method, which is computed simply by the acquisition cost divided by the useful life, and you get depreciation, or the acquisition cost minus the salvage value divided by the useful life. Then we have the declining balance method. So using a rate not exceeding twice the rate which would have been used had the annual allowance have been computed under the method in letter number 1. So another method would be sum of years digit method, and any other method prescribed by the Secretary of Finance. Then seventh item as deductible expense is the depletion of oil and gas wells and mines. So depletion meaning the diminishing of oil and gas wells, no? Or the evaporation of oil and gas. So it is part of exploration and development expenditures, which are expenses paid incurred before the development stage of the mine, intended to ascertain the existence, location, extent, or quality of any deposit of ore or other minerals. So the expenditures incurred in the exploration and development can be there are two options. It can be considered or treated as first part of the adjusted basis for depletion cost. So it is part of the depletion. Or it can be deducted or deduction to compute taxable income from mining operations. So if the taxpayer is engaged in mining operations, it can be used as a deduction. So if option 2 is taken, the total amount deductible for exploration and development shall not exceed 25% of the net income from mining operations, computed without the benefit of tax incentives. Then the excess of the 25% shall be carried over or forward to the succeeding years until fully deducted. Then the eighth item is the charitable and other contributions. It is a non-operating expense, but the law allows some contributions or gifts given within taxable year as a deductions from gross income. So if the property is contributed, The amount of charitable contribution shall be based on the acquisition cost of the said property. So if you are going to give a car and the acquisition cost of the car is 1 million, so the charitable contribution allowed is 1 million. So what are the requisites for deductibility? First, the taxpayer making the contribution must be engaged in trade or business or has a profession. Second, there must be an actual payment of a contribution or gift. Third, the recipient must be an entity or institution specified by law. And the last requisite is that the net income of the institution must not inure to the benefit of any individual or private stockholder. So the institution who is the recipient or who is the one who was given the contribution. So it must not benefit any individual or any private stockholder. Now, what are the contributions which are deductible in full? Meaning full amount. First, donations to the Philippine government or any of its agencies, political subdivisions, including GOCC. What is GOCC? Government-owned controlled corporations, which are made to finance, to provide for, or to be used in undertaking specific priority activities. In number 1, education, health, youth and sports development, human settlements, this is housing for the poor, science and culture, and economic development. Second, donation which is deductible in full, donations to international organizations in compliance with agreements, treaties, or commitments entered into by the Philippine government and the foreign institutions or organizations. Third, deductible in full, donations to accredited NGO or non-governmental organizations, which are subject to the following requisites. First, not more than 30% of which should be used for administration purposes. So, not more than 30% of the contribution must be used for administration for purposes. Second, the contribution must be utilized not later than the 15th day of the third month after the close of its taxable year. So it should be consumed or used not later than the 15th day of the third month. So that would be March 15 if the recipient adopts the calendar year. So March 15 of the next year. And then upon dissolution, a court shall distribute the assets of the said non-government organization to another non-profit domestic corporation or to the state, the Philippine government, or another similar organizations. So, okay. Now what about other contributions? Now other contributions are subject to limitation. The first, if the donor is an individual taxpayer, then the limit is 10% of the taxable income derived from trade, business, or profession. So it must not exceed 10% of its net income. No. Or the actual contribution, whichever is lower. So 10% of the taxable income or the actual contribution, whichever is lower. So if the donor is a corporation, then the limitation is 5% of its taxable income or the actual contribution, whichever is lower. Then the two contributions must be properly documented. So meaning the contribution made by the individual taxpayer or the corporation must be documented. There must be a receipt issued by the recipient. And then there is the ninth item, which is deductible from gross income. This is research and development or R&D. So a taxpayer has two options to consider how R&D incurred during a taxable year in connection with the taxpayer's trade, business, or profession. So the first treatment could be as ordinary and necessary expenses and deductible from the business gross income in the year incurred or paid. So automatic, all of the amount of the research and development is deducted from gross income. That's the first option. Another option, or as a deferred expense, no, which is chargeable to the capital account, but not chargeable to property subject to depreciation or depletion. So the expenses will be allowed as deduction ratably, so by ratio, distributed over a period of not less than 60 months, beginning with the month in which the taxpayer first realizes benefits from such expenditure. So 60 months is good for 5 years. So it can be deferred for 60 months to amortize as deferred expense. Okay, we're almost done, and this is the last, I think. The last item for as a deduction from business income is the contribution to pension and trusts. So this comprises a fund intended to provide retirement benefits to employees. It is usually set up after some years of operations when the employer is financially stable and already able to provide such benefit. So the employer is allowed to deduct it from business gross income, the contributions or payments made to the pension trust, which must be reasonable private benefit plan. Now there are two types of pensions, namely the defined benefit plan. In this plan, it is the employer who handles and manages the fund. So this is employer. No? And the benefits that the retiree receives is normally based on certain defined percentage of his salary of the eligible employee. So EE again is employee. The other type of pension is the defined contribution plan. This trust fund is handled by a third party. So normally it is an insurance company or a bank as the administrator. The employer is liable to contribute the defined or contracted periodic contribution as per agreement with the administrator, while the administrator manages the fund and is liable to pay the retirement benefits of the employees under the plan. So the retirement benefits of the retirees depends on how the administrator manages the fund to become profitable. So what are the requisites for deductibility of pension trust? Number one, the plan must be reasonable and actuarially sound. Actuarially sound. Then, second, the plan must be approved by the BIR. Of course, in compliance with the tax code. Okay, those are the itemized deductions. But there are other additional deductions to certain taxpayers. So the first, the employers or those employers who are employing senior citizens. So if they have senior citizens employed in the roster of employees, they are entitled to an additional deduction from their gross income equivalent to 15% of the total amount paid as salaries to senior citizens. So 15% of the salaries of senior citizens is deducted additional, no? Provided that the employment shall have to continue for a period of at least 6 months and the annual taxable income of the senior citizen does not exceed the poverty level, or the senior citizen is earning uh, the minimum wage. Then senior citizens are allowed some discounts. No? These are the discounts given to senior citizens: 20% for goods and services, 5% for water electricity consumption registered in his name, provided the consumption does not exceed 30 cubic meters, and 100 kilowatt hours per month, respectively, and 50% for electricity, water, and telephone if consumed by a senior citizen center administered by the government or domestic non-governmental organizations. Then there are also deductions allowed to employers or corporations who are giving rooming in and breastfeeding practices. You know, in some corners of a shopping mall, you can see lactating. You know? So the corporations are allowed because this is adopted by the state as a national policy to encourage, protect, and support the practice of breastfeeding. So the expenses incurred by the private health institution complying with the tax law shall be deductible from income up to twice the actual incurred during the taxable year. So if there is a construction of lactating room, so the cost of lactating room can be deducted from its gross income. Another deduction allowed to certain group of taxpayers, this time for lawyers or general professional partnership rendering free legal services. They are entitled to an allowable deduction from gross income. The amount which could have been collected for the actual free legal services rendered, or up to 10% of the gross income derived from the actual performance of legal profession, whichever is lower. So this exclude the 60-hour services provided to indigent litigants, which is mandatorily required. So lawyers are required to render 60-hour services to indigent. You know what is an indigent? Poor litigants. So the free legal services are provided for those who can afford. So, or in excess of the 60-hour provided to indigent litigants. Another allowable deductions are afforded to private or educational institutions. They are allowed to treat capital expenditure either as a deduction to its gross income as expenditures, or deduct immediately, or deduct as allowance for depreciation. So the first, deduct immediately as gross income, or deduct as allowance for depreciation. Example, CIT, make the erection of, or the building of, the erecting of the new building, no? Its cost relative to the construction can either be treated as letter A or as letter B. Okay, so this ends chapter 8, and all these expenses, this pension trust, bad debts is deducted from gross income. Taxes, interest are deducted from gross income. So these are all the deductions allowed, and its acronym is Exentaloba Dip Dip Chari Pen. So you study, and for any questions you email me. So you can get the answers, because answers leads to knowledge, and knowledge gives you power. And good luck to the final exam. This will be included as theory. There will be no computation in this part. Okay, congratulations. You're almost done with taxation 231.